Hi, and welcome back to another episode of the Neighborhood Ventures podcast. I'm Bart Diehl, and today I'm joined by co-founder of Neighborhood Ventures, John Kowalski. Got a good slate of topics today. We're going to talk about our properties, specifically properties in the Opportunistic Fund. So, John, the first property I want to talk about is the first acquisition we made at the end of January this year in 2025 in the Opportunistic Fund. Upon acquisition, it was 72% occupied. Now it is over 85% occupied, and rents are being leased at close to or at market rates. So, just quick update: what's going on with this property? What are some of the bigger wins?
You're talking about Colter.
Correct.
Okay, because we bought two of them very close together.
Yeah.
So, short story is, you got to understand, this is like, here's an analogy. When you go out and buy a used car, my mechanic told me years ago, there's always work to be done. So we know that there's work to be done, but there's the things that you're like, yeah, of course you're going to have tenants that the old management company stuck in there. Of course you're going to have things that they hid. Of course you'd have things that no one talked about, especially when we buy properties that are bank owned and distressed. So no big surprises, not crazy stuff. The only things that we've had to deal with a little bit, we found out we had a group of tenants that were construction workers from a construction company.
Yeah.
And when 12 left, we ended up with 12 vacancies. So you end up with that. We have a couple tenants that were stragglers, and the management company kept them on because we had a directive in our contract to keep them at a certain occupancy. So we realized that they were not the type of tenants that were going to stay long term. So we had to do a little weeding of the tenants. We call it weeding, like weeding in your garden.
Yeah.
And now we're to a really good base, and we're climbing. Property's running really well. We've done some cabinet door replacements instead of kitchen upgrades.
Yeah.
We've done some flooring work. Excuse me. Some of our units what they tried to do were polished concrete floors. The concept sounds amazing. The reality is you don't want to live on a concrete polished floor.
Yeah.
It just doesn't feel comfortable.
Yeah.
I'm just telling you, it feels like a basement. And so we had some pushback. That was the decision the prior owners had made to do the polished concrete floors, and we're starting to put some of those in. These are things we budgeted in, small improvements to the property on turnover. Our manager is fantastic, Natalie.
Yeah. One of the things I noticed, or I saw, she posts updates on how the property's performing, obviously in our channels of communications here, and I saw that our Google reviews have gone up from like 2.5 stars to 5 stars from the tenants there, which is incredible since taking that over.
She's on top of it, and then Rigo. The other thing we've asked Rigo, who was one of our heads of construction, to transition to maintenance, and now we're making him head of all of our maintenance. He's now come through a big learning curve, which is really important for us. Understanding how every time we have some work done on the chiller system or air handlers in the unit or whatever it is, he sits down, watches what goes on, asks a bunch of questions, asks where to buy the parts, and most times he's like, I could do that myself, and I'm like, there we go.
Yeah.
So his learning curve is, having him do the work at his hourly wage, and also at his skill level. Like he's a very detail oriented person. To have him do that versus the guys come rushing in and say, we'll just got to fix it because we have to get the chiller system running while it's hot, and then run to the next building and the next building.
Yeah.
It's been a good thing for us to have that happen. So the property, I feel, very stable, got a good base of tenants. Our occupancy is where we want it to be.
Yeah, that was the biggest thing when we bought the building was, hey, we're acquiring a really strong asset, distressed at a significant discount, but it's only 70% occupied. So there's a long way to get to 100%, and we're hitting those benchmarks. So being up, over 15% right now from when we bought it, that's a great start.
Yeah, and again, 2 steps forward, 1 step backward.
Yeah.
But that's going to happen. Look, folks, just got to understand, 15 years ago when we were in the last distressed market, when you bought a distressed asset, it was horrible. It was burned out units, broken windows, people that are occupying units that had broken in and were camping in there. Massive, problems with the property, let alone the kind of tenants are stuck in there. This is not, luckily the assets we bought are distressed, failed assets, not cannibalized, gutted assets. Whole different category. But there's still going to be some things that come up. And that's why I'm pointing it out. People go, why aren't you 100% occupancy? We're like, well, the market's 93%. If we're 85 and growing, I'm very happy with it.
Yeah. Great. Well, I want to talk about the next asset we purchased in the Opportunistic Fund, but investors also had the option to invest directly into it, which is Venture on 52nd. So we closed on Venture on 52nd in mid-March. Again, I had the conversation with our PM. When we acquired it, it was like 89, 90% occupied.
Yep.
We're at 94% occupied. The key mission here at this property is we have some small capital improvements we're going to make. And then two, we need to raise rents to market rates. The previous owner had rents severely under market rates because she was trying to get over 90% occupied to be able
to restructure her
exactly.
debt. Right.
So just to give a quick update on the minor capital improvements, where are we at with everything?
Yeah. So first of all, the things we identified worked out very well, and sometimes even better than we thought. I talk about this often; it feels like a broken record, but there were a couple units on the street side, on Thomas Road side, that were hard to rent. One of them in the corner because it was a studio apartment and didn't have a lot of light to it, and then a couple other, and also was very loud with a few windows. The few windows it had that were on Thomas, and the other ones that had some of our best units that had balconies facing overlooking Thomas Road, but looking at Camelback Mountain.
Yeah,
and those were loud units. It was a very easy fix. We took out the windows over there and the we call them Arcadia doors, the sliding doors, and we put in new updated double pane sliding glass doors that are filled. The gap between the panes are filled with argon gas. Doesn't allow sound transmission.
Yeah,
and it changed everything. Now we've got really nice looking units that are now quiet. That worked out really well. Second thing is we identified that we had an area on the east side of our property. East side of our property that was along the fence line with our neighbor, that was just boxed off and locked off. And we said, well, there's a window there. We can cut the window down into a door, and we can put patios in and put semi-private patios. Again, my thing is I've seen what happens when we block off the whole area and turn it to a patio that only has access by that unit. It gets filled with bicycles, old camping equipment, whatever it is.
Yeah.
And what we did is we just did this pony wall that steps down, and we put paving stones down. We dropped the doors in. That corner unit that was a studio unit that had not a lot of light, we put a patio in it. We put a larger door in there, a sliding glass door. It's now beautiful.
Yeah.
So now we have 10 units just on that side that are now sought after. We looked at the return on investment on that. It's about a 2.5-year return investment, but from the rent increases. I think it's going to go faster than that because we couldn't raise the rents to what we thought was going to be the market for those units with those improvements day one because we actually worked in some of those units with tenants in there.
Yeah.
So now you can't go back to them and go, hey, let us tear up your walls and make a mess of your place. Yeah. And by the way, when we're done in a week, your rent's going up $300. It doesn't happen like that. But on renewal, we're saying, hey, if you want to stay in this unit, this is going to be the new rent. That's worked out. We determined that we didn't have to put in 4 garbage enclosures. We are going to do 2. And the reason why we only have to do 2 is because the garbage company came back and said, well, we can give you a larger dumpster container, pick it up twice a week, instead of the 4 smaller ones that are picking up once a week.
Yeah, which takes up way less space in the...
Parking's a premium over there. We know we have tight parking, so that helps a lot also. Yep.
Yeah, and you mentioned renewals. So since acquisition, we've had 12 new leases signed, and these leases are climbing towards market rents. And we also had 15 renewals signed and are either at market rents or above market rents being renewed at. So big win from our property management team there at that property. And again, the goal here is we want to raise rents to market rates. We can look at NOI. Our operating expenses are down, and our net income is also up. So from when we acquired it, there's been a significant increase in what our NOI looks like.
And we've got a better quality tenant too.
Yeah.
Once you get a little better rent, and we're on top of stuff, and people generally like that property. It's working out really well for everybody.
Yeah. Well, the third property I want to talk about in the Opportunistic Fund is Venture on 12th Place. So let's talk about 12th Place. This is a property that we made a strategic investment into to refinance the debt. So basically buy down the debt so the property can be into a fixed rate loan. What does that refinance do for the property, John? What are the steps moving forward for 12th Place?
Right. So, the issue we've had, and we're not alone, the whole entire industry's got the same, grappling with the same issue, is that if you had a loan that was adjustable rate, You needed to try to move it to permanent rate, but a lot of times you're in the middle of construction. You haven't hit your 90% occupancy. You're in some not stabilized position. That property was caught in that place.
Yeah.
What we were able to do was Jameson and I personally signed a full recourse loan, which is a little scary, but we did that for the benefit of our investors and the property, and came in with some opportunistic fund investment. Our loan to value on that property, if you want to put it like this isn't money being thrown at something called a rate cap, which is money out the window, but it reduces your payments.
Yeah.
This isn't money being put into the property to, any of the money that just disappears. This is real money going to pay down real debt. So our loan to value on kind of what our exit sale price is going to be, we're like 25% LTV.
Yeah.
So we have like a 25% LTV loan. If you want to think about it like that, puts us in a much better position.
Yep.
Drops our debt costs, puts it in a position now where we can run the property more effectively, and it's a really nice property. Most of the investors that have walked that property love it. The townhome style units appeal to a certain type of resident.
Yeah.
The single story ones appeal to another type of resident. It stays full, and the location keeps getting better and better. 12th place.
we made great renovations on this asset. Since acquisition, occupancies, or after the renovations, we're over 90% occupied, and rents have doubled at this property.
Correct.
So it's definitely a property you want to hold long term. And to your point, we basically converted $2 million of debt into $2 million of equity. Great. So the next asset I want to talk about in the Opportunistic Fund is venture on Maryland, which is actually not quite yet in the Opportunistic Fund. We are under contract on this building right now.
Right.
But John, tell us about Maryland. How long have we been following this asset? Where are we at in the process?
Yeah. I'll step back, just a little history on it. This property was owned for 30 plus years by somebody I used to know that was one of the grandfathers of the multifamily brokerage business. Mm-hmm. It was in his family trust, and I think it might have been his last property he sold in 2022. Always ran the property well. The neighborhood was always a stable neighborhood. North Phoenix, North Central, uptown, however you want to describe that neighborhood, between the sevens, another way, between 7th Street and 7th Avenue. It's just off that, but it's in there. Anyway, it sold in 2022 for over $17 million. The buyer of the property, ironically, is the same person that used to own 52nd Street. Yep. The lender is pushing the sale. We've worked out a deal with the lender to come in to rewrite the loan for us at a better rate and provide renovation dollars. The lender's very comfortable with the property, obviously, and that's a good thing.
Yeah. Very,
very comfortable with us and our ability to renovate it. And in that marketplace, that property is a diamond in the rough. I've used that phrase before, but we had another property on Marlette right around the corner, and we did the same thing. It's a neighborhood that responds very, very well to renovations. It's just difficult to find those assets.
Yeah.
And we're buying it at a really good metric at $137 a unit to buy that property. And the renovations we're doing are not big, heavy lifts. They're cosmetic. The last owner, not the one that we're buying it from, but the 30-year plus owner 5 years ago did the chiller system, all the piping, sewer lines. We verified that there's all ABS plastic pipe for the sewer lines. Those have been replaced. The roof was done.
Yep.
The big things are done. We're going to have to go back in and redo the landscaping. They've had some failure of the sprinkler system, so they've lost some landscaping trees. We're going to do cabinets, new appliance package, flooring, all these things. And I would say that the way that property's been operating, pretty full. It's just that the tenant profile in that area wants to be in there. A lot of those tenants that are in that area want to be around their synagogue, their church,
Yep.
Their grandkids' schools. They've lived there, grew up there. They don't want to leave, and they're very comfortable with it. We've heard a couple stories of tenants that had moved across the courtyard because the current owner of the property did a light reno on 12 units. When I say light, they put new cabinet doors on, new cabinets. They put a new vinyl plank flooring down and new paint. That was it. I mean, it's still kind of creepy bathroom, shower cabinet, things that or wall tile that wasn't the best looking. Anyway, we're going to do a much better renovation on the rest of the units, and it's what we're good at, and it's fairly cost effective because they're very simple kitchens, and that property deserves it. It's going to do very, very well. So we're in the right price point in a neighborhood that is going to respond very well to that work, to a property that's had good occupancy, but and fortunately been owned by an owner that's been just caught up in a turmoil. That bought a lot of assets in 2022, and the rates were adjusted, and everything started falling apart. So we're going to step in and be able to step in with 3-year stable debt, and get the property renovated. And we're not going to clear out the property. That's important too. We're doing about 8 units at a time.
Yep. So to John's point, the two biggest things we need to do here is, one, the capital improvements. We have a budget, we have a schedule, a plan for how to accomplish this. And then number 2 is raise rents to market rates. Right now, it's 1 bedrooms at this building is renting for about $1,100 per month.
Correct.
Market rents are closer to $1,500. So there's a lot of room after capital improvements to grow and get into that market rent space. But yeah, Venture Maryland, very excited about this one. We're happy to have this one join the Opportunistic Fund here in the next few weeks.